Hi, I'm Kathy Scott, Editorial Manager at Institutional Investor Journals. And joining us today is David Teten. He's a partner at FF Venture Capital and founder and chairman of the Harvard Business School Alumni Angels of Greater New York. David is lead author on an article in the Journal of Private Equity called The Lower Risk Startup: How Venture Capitalists Increase the Odds of Startup Success. Welcome.
Thank you.
David, would you start by giving us a brief overview or summary of your article?
Sure. So we were studying a trend that we've seen in the VC industry, which is a trend towards larger funds with more staff, and a trend towards more pyramidal structure. Historically, the VC industry had an upside-down pyramid, just partners and maybe some administrative assistants, but now we saw more funds that were adopting more of a traditional pyramidal approach. We found that there are three main categories of VC strategies with regard to addressing portfolio operating issues in companies. One, the financier strategy, looks like a hedge fund. It's a primarily quantitative approach where they invest capital and typically are not much involved beyond that. The second strategy, which is by far the most common strategy, we call the mentor strategy. And that's the traditional model of VC. Sit on a board, provide some advice and counsel, make some introductions. The third strategy is a portfolio operator VC, typified by firms like Andreessen Horowitz, Google Ventures, First Round Capital, and my firm, FF Venture Capital. Firms following this strategy tend to have much larger teams at all levels, meaning analysts, associates, principals, and so on, and provide systematic, standardized support for their companies. Our research shows that funds with this strategy tend to have much better returns than the VC industry as a whole, which has had mediocre returns. And this is consistent with other research done by separate academic groups, showing, not too surprisingly, that when you get more engaged with companies and add more value to them, the odds that they're going to be successful go up.
And how do portfolio operators feel about using their unique personal and fund assets to develop their portfolio companies?
It's their job, and they typically enjoy it. It's a good profession to be in. And the people with this strategy believe that it enhances returns.
So give me some examples of how they do use those personal assets.
So the primary way is recruiting. That's certainly the most commonly listed way in which firms add value, because by definition, companies are growing, and that typically means they're adding more staff. So VCs spend a lot of time looking for talent. In the case of portfolio operator VCs, they'll build out teams of folks to do that, who might do work like tracking companies that are dying in order to pull out talent from them, and tracking people across the portfolio. So a junior programmer in one company who may not see a path for advancements can then move to another company where there's a more appropriate role for him. That's good for both companies because he gets a smooth transition out of company A and gets a good role at company B, and we as an investor are happy that someone has been able to build a career across the portfolio.
I assume that this changes the operational structure, though, with these companies.
From the VC point of view, it means typically a larger team and folks with more of an operational background as opposed to a pure financier background. From the point of view of the individual company, it means that companies can focus on their core competency. An easy example is finance. We very rarely get CPAs coming to us seeking to raise capital. It's a different skill set, different psychology. And most CEOs are very happy to outsource their financial CFO needs to us. We have a team of folks who provide outsourced financial services to companies, effectively as their default CFO. We have over a dozen companies using that service. They're not required to, but they're usually very happy to have the burden of that taken off their shoulders by people who specialize in doing that for tech startups.
So what are the industries then that approach works best in?
So I think this approach is generalizable across the startup community. In practice, the VC industry is heavily biased towards IT and healthcare, and so that's where you see this pattern most evidence. I'd say it's more clear so far in the IT industry than in healthcare, but I anticipate over time you'll see this strategy adopted in the healthcare space as well for the same reasons.
Do you have a real-life example that you can share?
Many. So, for example, today, our portfolio company, Ionic Security, announced that they had raised close to $10 million from Kleiner Perkins and portfolio operators and a number of other investors. We were the first institutional investor in the firm, and among other things, we provide their financial back office. So that's one less thing that they need to worry about so they can focus on developing their product and winning their clients.
And what's the reception? You said it was rather positive from the startup company standpoint with this proactive approach.
Yeah, so I spent a lot of time talking with CEOs of early stage companies, and when I say we're going to take this burden off your shoulders and we can help you with recruiting and we can help you with templates of how to build your company so that you can make new mistakes instead of recycling the same mistakes that other people have made, they're usually pretty happy about that. That doesn't mean it's universally popular. I'm sure when we're out of the room, some entrepreneurs complain about too much meddling or too much involvement from their VCs. And I view that as an example of the conflict between rich and king that Professor Noam Wasserman talks about in his book, Founder's Dilemma. He says, as an entrepreneur, you can choose to be rich, meaning build a high-value company, of which you will typically be a minority shareholder, or king, meaning you maintain a lot of control, but usually your company is not worth so much. Mark Zuckerberg gets a lot of press because he succeeded in being rich and king, still retaining to this day majority control of his company. But most entrepreneurs do not succeed in doing that. We look to back people who want to be rich, because that's our job as a fiduciary, and it means that they realize that over time they're going to bring in other colleagues who will grow the firm. They'll bring in a board of directors who will be competent people who may not always agree with them. Our job collectively is to grow a high-value company.
So what are some of the other areas within a company that you can add operational support?
Another area is the service providers. All companies spend money on service providers, PR firms, legal firms, SEO firms, and so on. And the problem with being a startup in this context is you have no leverage. You have no brand, you're not a prestigious client, and if the service provider does a bad job for you, it doesn't matter to them because you're not going to be a big source of business in the near future. However, if, as in our case, we've built a pool of preferred service providers in all the major categories that early stage companies need, and the service providers know that if they do a bad job for one of our companies, that will be reported back and they'll be off the list. So that gives them a stick with which to ensure that the service provider does a good job for them.
Is this a crowded strategy at this point?
I don't think so. I can point to a very short list, like the firms that I mentioned, of VCs who have adopted this strategy. So far, the VCs doing it are typically larger, later stage funds for a very simple reason, which is it takes a lot of money in advance to be able to afford a large staff. We do this strategy in the early stage space, and we're the only ones that we know of doing it at our scale. We can only afford it because we have good returns in our past, and we're reinvesting that in our business.
So is that an important aspect in all of this, understanding what your strengths and weaknesses are when you're trying to determine whether or not you want to approach in venture capital investing as a mentor or a financier or a portfolio operational strategy?
From the point of view of an individual VC, I think they should think carefully about their strategy versus the competition. The VC industry has become more transparent. So, for example, it's very easy to see which companies are raising capital on AngelList and other like databases. So you have to have a clear differentiation because your cash is as green as others. What else can you bring to the table? Entrepreneurs who you want to back are very selective about identifying the people who add the most value. And there's a very, very strong word of mouth effect between the entrepreneurs as they ask who's really going to be helpful. So as an entrepreneur, that's what you should filter for. And as a VC, I think all those strategies can be successful, the financier, the mentor, and the portfolio operator, but they imply very, very different decisions about how you staff and how you invest, and you should adopt that appropriately.
So what are the advantages and disadvantages that a financier or a mentor approach brings?
For the financier, there are a few advantages. One is it is in theory a more scalable strategy. Correlation Ventures, which is the poster child for this strategy, has 175 million plus in assets under management, which is more than many VCs, certainly in the early stage world. Another advantage, you can typically have a smaller staff because you're relying on math and analytics as opposed to a lot of hand-holding. So that implies that you as the GP make more money. The concerns about it from an LP point of view are if it's just math, how sophisticated is the algorithm, how copyable is it, which is exactly the same question that an LP would ask about a quantitative hedge fund. From the point of view of the entrepreneur, there are certain cases where you as an entrepreneur just want to raise cash. You just want more money that you can spend and you don't really care about anything else. Correlation Ventures advertises that they offer very fast turnaround. They deliver that, and they're a good investor in certain cases. For the mentor strategy, the advantage is that it's a historically proven strategy. It's relatively low cost, It's consistent with the way most VCs operate, which is as a set of individual entrepreneurs, meaning at many VCs there are, say, 5 partners. Each has his or her own book of companies, is engaged with those companies, and doesn't necessarily communicate much across with the other companies. So this is consistent with that model. The portfolio operator strategy requires significant investment of capital by not the LPs, by the fund itself. And they can only do that if they have the self-confidence to believe that that will yield long-term returns. All these strategies have effectively the same fee structure from an LP point of view. So as an LP, the question you should ask is who's going to generate the best returns? And we think that this portfolio operator strategy, which is too expensive for many people, is going to yield better returns.
So what's the major takeaway from all of this for VC, and then how might that differ for a private equity firm?
I think all VCs should be aware of this trend, and they are. There's certainly a lot of discussion in the VC community about firms like Andreessen Horowitz, which within 3 years has gained a reputation as a top-tier firm. And some firms are trying to adopt a strategy that looks like theirs. Within the private equity community, there's a very different dynamic at play. The operating partner strategy in private equity is well established. I'm a member of a group called PE Open, which is a network of operating partners at large PE funds, typically with 500 million assets and above. We estimate there are about 500 people in the US who qualify to join the group. And the firms like Riverside and Welsh, Carson, Anderson, and Stowe are known for this strategy. So the actual day-to-day of the operating focused partners at these firms does look a little different from the sort of work that I do. Typically, they're using less technology to engage with the companies and not building their own software stack to support the companies. And that reflects the areas in which they think they can add value. They do spend a very large amount of money on service providers of various sorts. And the logic of that is they have the budgets with which to pay Bain, McKinsey, BCG, et cetera, to do work for their companies. And so they spend a lot of time managing those service providers. In my space, we don't spend as much time doing that. We're not controlling the size of budget that my peers in the private equity world are.
And what about limited partners? Should they be trying to add operational value to their GPs?
So that's a really interesting question. I can't point to a single example of an LP that is pursuing what I would call a portfolio operator strategy. We have certain LPs who refer us deal flow, and that's, I'd say, the extent of the relationship. Some of them serve on our advisory board and advise us if there are conflicts of interest or other matters, which is typical in the industry. I think that one deduction one could make from this research is an LP should investigate a portfolio operator-like strategy. I could envision an LP that said, we're going to help our GPs, help our funds in sourcing of new managers, in raising capital, so they don't have to worry as much about that, and in other areas where an LP has a privileged position to add value. In the hedge fund world, there's a phenomenon of hedge fund seeders, so entities that raise capital and effectively incubate new hedge funds. So that's probably the closest comp to what I call a portfolio operator strategy in the VC world.
Okay, thanks very much for joining us today.
Thank you.